June 25, 2002. Inside WorldCom's boardroom in Clinton, Mississippi, a decision is being made that will obliterate a $100 billion empire overnight. The board has just fired its chief financial officer. Its controller has resigned. And the company is about to confess something staggering to the Securities and Exchange Commission: $3.8 billion in fraudulent accounting entries fabricated across 5 consecutive quarters. Within weeks, 17,000 people will lose their jobs. Within a month, WorldCom will file for bankruptcy. $107 billion in assets, the largest corporate bankruptcy in American history at that time. Investors will watch $180 billion in market value disappear. Pension funds across the country will be gutted. And the man who built this company from a coffee shop napkin sketch, a former basketball coach from Mississippi named Bernie Ebbers, will eventually be sentenced to 25 years in federal prison. But the strangest part of this story is not the scale. It is the simplicity. No offshore shell companies, no labyrinth of derivatives or hidden subsidiaries. Just a small group of executives quietly moving numbers from one column to another, quarter after quarter, while 88,000 employees went to work every day with no idea their company was built on fiction. So how did it get this far? And who finally looked close enough to see it? The story begins in 1983, inside a coffee shop in Hattiesburg, Mississippi. Bernie Ebbers and 3 investors hatched a plan to resell long-distance telephone service at discount rates. The company they formed, Long Distance Discount Services, didn't build its own infrastructure. It leased lines from established carriers and undercut them on price. It was lean, scrappy, and almost immediately in debt. By 1985, with losses mounting to $1.5 million, the other investors handed Ebbers the CEO role. He was an unlikely corporate leader. He held a degree in physical education from Mississippi College. He had coached junior varsity basketball. He had run a chain of motels in Mississippi where he personally cleaned every room and washed the linens to save money. He was not polished, but he was relentless. Within a year of taking charge, revenue climbed to $8.6 million. Within 2, it reached $18 million. But Ebbers understood that organic growth in a crowded telecom market had limits, so he pursued a different strategy: acquisition. Over the next decade, WorldCom consumed more than 60 companies. The crown jewel came in 1998 when it merged with MCI Communications, a firm 2.5 times its size, for $37 billion, the largest corporate merger in history at the time. Wall Street loved him. They called him the Telecom Cowboy. Boots, jeans, and a salesman's instinct. By early 1999, Ebbers was worth an estimated $1.4 billion, ranked 174 on the Forbes 400. He owned the largest ranch in Canada, 500,000 acres in British Columbia. He owned yachts, timberlands, a lumber company, 9 hotels, and a minor league hockey team. He taught Sunday school every week and opened corporate meetings with prayer. WorldCom employed 88,000 people, operated 60,000 miles of telephone line, carried half of all U.S. internet traffic, and posted revenues nearing $40 billion. Then the music stopped. A proposed $115 billion merger with Sprint Corporation was blocked on antitrust grounds. The telecom market contracted. The dot-com bubble burst. WorldCom stock, once at $62, began its descent. And Ebbers, who had borrowed over $400 million from JP Morgan secured against WorldCom shares, was now dangerously exposed. If the stock kept falling, everything he had built and everything he owned would collapse with it. Fraud mechanism explained clearly. To understand how WorldCom's fraud worked, you need to grasp one accounting distinction: the difference between an expense and an asset. An expense is money spent to keep operations running: salaries, rent, the cost of leasing phone lines. It hits the income statement immediately and reduces reported profit. An asset is something purchased that generates value over time. It sits on the balance sheet and its cost is spread across years. WorldCom's largest recurring expense was called line cost, the billions it paid to lease telecommunications infrastructure from other carriers. When revenue began declining and the market turned, these line costs started destroying margins. CFO Scott Sullivan looked at the quarterly numbers, didn't like what he saw, and directed Controller David Myers to reclassify billions in line cost expenses as capital assets. Instead of recognizing a quarterly cost all at once, it would be amortized over 10 to 15 years. The effect was immediate. Expenses shrank on paper, profits appeared, and Wall Street got exactly the numbers it expected. On top of this, WorldCom drained $2.8 billion from its reserve accounts and reclassified those funds as revenue, further inflating the illusion of a thriving company. The combined distortion eventually reached $11 billion. The entries required almost no documentation, sometimes just an email from Sullivan, sometimes a verbal instruction. The accountants who physically entered the figures, people like Betty Vinson and Troy Norman, often had no supporting paperwork whatsoever. They booked the entries because their superiors told them to. The label invented to categorize these entries was prepaid capacity, a term that no one in the company could properly define because it didn't describe anything real. Red flags and discovery. The first warning came from within. In late 2000, budget analyst Kim Imai was ordered to reclassify labor costs as capital expenditures. He believed it amounted to fraud. He pushed the concern up the chain of command. The directive was halted, but shortly after, Imai was fired. His story reached the Fort Worth Weekly newspaper in May 2002. That article landed on the desk of Glenn Smith, an internal audit manager at WorldCom headquarters. Smith flagged it for his boss, Cynthia Cooper, vice president of internal audit. Cooper decided to start a scheduled capital expenditure audit several months early. Her team discovered $1.4 billion in entries labeled prepaid capacity with zero documentation, no invoices, no receipts, nothing. Cooper asked Corporate Finance Director Sanjeev Sethi what the term meant. He couldn't explain it. She approached Controller David Myers. He pushed back. Sullivan personally called Cooper and asked her to delay the audit until the following quarter. Myers sent emails calling the investigation a waste of resources. To avoid raising alarms through increased server activity, Cooper's team began working at night, pulling data after hours. Eventually, Myers admitted the entries had no accounting justification. "They were booked," he said, "based on what we thought the margins should be." Cooper brought her findings directly to the audit committee of the board. The fiction was finished. System failure. The fraud persisted not because it was clever, but because every safeguard failed. Arthur Andersen, WorldCom's external auditor, the same firm that would be destroyed by Enron, never tested the relevant capital expenditure accounts. The SEC later concluded that Andersen missed several opportunities to detect the irregularities and that WorldCom personnel deliberately withheld information and altered documents. Inside the company, a culture of silence protected the scheme. The SEC found that employees believed that forcefully objecting to conduct directed by Sullivan would cost them their jobs. The board of directors remained uninformed, and Ebbers's $400 million in personal loans collateralized against the stock created an overwhelming incentive at the very top to keep the illusion alive at any cost. Collapse and human cost. By early 2002, the walls were closing in. Moody's downgraded WorldCom's debt to junk status. On April 30th, the board forced Ebbers to resign. On June 25th, the company publicly disclosed the $3.8 billion fraud. Sullivan was terminated. Myers resigned. The SEC filed civil fraud charges the very next day. On July 21st, WorldCom filed for Chapter 11 bankruptcy. Subsequent investigation revealed the total overstatement was $11 billion. The company was rebranded as MCI and eventually acquired by Verizon in 2006 for just $8 billion, a fraction of what it once claimed to be worth. 17,000 employees lost their jobs overnight. Many had retirement savings invested in WorldCom stock through the company 401(k), stock now worth nothing. New York City pension funds lost over $200 million. Oklahoma State pension funds lost $66 million. Across the country, institutions that trusted WorldCom's reported strength were devastated. Sullivan received 5 years in prison. Myers received 1 year. Ebbers was sentenced to 25 years. He was released early in December 2019 due to declining health, legally blind, suffering from dementia. He died 6 weeks later at 78. Betty Vinson, the accounting director who followed orders she knew were wrong, received 5 months in prison and 5 months of house arrest. She had considered quitting. She stayed, afraid to lose her income, afraid to defy her superiors. Psychological autopsy. It would be easy to reduce Bernie Ebbers to a caricature of greed, but the reality is more instructive. He built something real, took a coffee shop idea, and turned it into a global telecom power. The problem was that his identity became inseparable from WorldCom's stock price. His fortune, his loans, his ranches, and yachts. All of it was tied to the shares. When the market shifted, he couldn't accept the narrative of decline. Sullivan likely began with what he thought was a temporary correction. Adjust this quarter. Fix it next quarter. Was unbridgeable. The fraud didn't start was unbridgeable. The fraud didn't start with a master plan. It started with a refusal to accept the truth, compounded by the quiet compliance of everyone underneath. Ebbers told his church congregation after the scandal broke, "You aren't going to church with a crook." He may have genuinely believed it. That is perhaps the most dangerous quality of this kind of fraud. The people at its center often convince themselves it isn't really happening. WorldCom helped catalyze the Sarbanes-Oxley Act, one of the most sweeping corporate governance reforms in American history. It made CEOs personally liable for financial statements. It mandated independent audit committees. It created protections for whistleblowers. But the fraud was not uncovered by regulators, or by Wall Street analysts, or by the external auditor. It was uncovered by one woman pulling data late at night, after her own superiors told her to stop looking. Cynthia Cooper was named one of Time magazine's Persons of the Year in 2002. The systems failed. One person didn't. That distinction matters. Because the next fraud, wherever it is forming right now, won't announce itself either. It will look respectable. It will have impressive numbers. And it will last exactly as long as no one is willing to look.